Hello students, I'm Professor Sanyata. Welcome every student and viewers to my risk management lecture series 12. In today's lecture, I'm going to discuss the different learning objectives. First, meaning of investment risk. We're going to start from today's session, the details about investment risk. So we'll have a look about what is investment risk, although we have already covered it in lecture 1 or 2, where about what is investment risk. Next is types of investment risk and its identifications, types of investors and investment companies. So let's start with the first one, that is meaning of investment risk. Investment risk can be defined as the probability or likelihood of occurrence of losses related to the expected return on any particular investment. Whenever we invest our money in some investment avenues, we expect some amount of return from the investment, but not always necessary that we get that expected return. So whenever there is a chance that losses may occur, we say that there is a risk, and that risk that is associated with investment is termed as investment risk. Now, so stating simply, it is a measure of the level of uncertainty of achieving the returns as per the expectations of the investor. It is the extent of unexpected results to be realized. Types of investment risk. The first category is market risk. There we can see there is equity risk, interest rate risk, currency risk. All these are a type of market risk. Next is liquidity risk. It is also a type of investment risk, credit risk, inflation risk, foreign investment risk, horizon risk, longevity risk. All these risks are related to investment risk. Now moving on to our next topic is types of investors. Types of investors, there are basically two types of investors. The first category is institutional investors. Institutional investors are like entities having large amounts of funds to invest in an organization or on behalf of others. The second category is private investors like you and me, who manage their own money, they plan for our retirement, save for a large purchase, etc. Now, who are institutional investors? Basically, institutional investors comprises of the first category that comes to our mind instantly is investment companies. Investment companies are, you can define it in a simple term that it is business entities engaged in the business of investing the pooled capital of investor in financial security. These companies they manage, sell, and market funds to the public. Our next category is pension funds. This is funds used for a worker's future benefit, invested on the employee's benefit, have contribution of employers and earnings on the investments, generate income to the worker upon retirement. Next category is insurance funds. We have already seen what is insurance fund. And endowment funds are like donation or investment fund that is deductible for daily also tax deductible. It is usually done by a foundation that makes consistent withdrawals from invested capital. Now, investment company, we'll just have a look in detail to the different investment company. An investment company is a corporation or trust engaged in the business of investing the full capital of investors in financial securities. So actually what they do is that they collect the funds from different individual investors and they pool the capital and then invest in some investment agreement on behalf of the individuals. This is actually their business. So they are conduct investment company. These are non-finance banking companies that are primarily engaged in the business of buying and selling securities. Basically, the investment companies are divided into three kinds. Open-end management investment companies and this in terms of like they are mutual funds. Open-end means anytime you can invest in a fund, it is always open throughout the year. Anytime you can invest in it. Other category is closed-end management investment companies. So closed-end means investors are expected to invest their fund in those funds within a time frame that is given to the investors by the company. The third one is unit investment trust. These are also called unit trusts. This unit trusts they share the similarities of both the closed-end and open-end mutual funds. Here also, the investment company holds the portfolio of stocks, shares, debentures, and other money market instruments purely for investment purpose. Like open-end funds, most of this can get and sell directly from the issuing investment company, while in some instances, these were also quoted on the secondary market. Unit trusts, they often have a low minimum investment requirement, and the shares can be bought and sold anytime the investor wants. So the investment companies, they actually give an advantage to the small investors to make the investment in the wide array of securities which otherwise would not have been possible. So this is the basic advantage of investment companies who make investment on behalf of the private investors. So here we end our lecture of today's session. In the next lecture, we are going to cover, we are going to start discuss about a new type of fund that is hedge fund. We are going to see what is hedge fund, what is the difference between hedge fund and mutual funds. So hedge fund basics we'll see, the working of the hedge fund. We'll also throw some light on the working of hedge funds, how they work. Then hedge fund strategies, we are going to see what are the different strategies that are used by hedge funds. Hedge fund risk, different risks that are associated with hedge fund. Benefits of hedge fund, what are the different benefits of hedge fund, that also we'll have a look. Analysis of hedge funds, that is analysis of the performance of hedge funds, how the different performance of different hedge funds can be analyzed. That we are going to see. So here we'll end today's lecture by that. So I thanks all my viewers and students for watching my video. Till the next lecture, goodbye to everyone. Thank you.